I read that in high school that, he was very entrepreneurial, and he filed his first tax return at age 14, actually used his bicycle as a tax deduction, probably running a paper route or something. And that, by the time he graduated, he had almost $10,000 saved up, his own money. This wasn't his father's money or his mom's money. This was his own money through his own hustles that he did. And today's dollars, when he graduated high school, in today's dollars, this is equivalent to $120,000. Can you imagine having $120,000 today, having graduated high school? So, Buffett he's always been a hard worker. He's definitely attributed a lot of his success to the people he surrounded himself with. But I think that he proves that you kind of make your own opportunities in life.
All right. Well, welcome to the Money Alchemist podcast. My name is Brent Gargano.
And I'm Ben Jones.
And we wanted to spend a little bit of time today reflecting on the life and some of the lessons learned from Warren Buffett. I think anybody listening to this is, of course, aware of who Warren Buffett is. We recently had the Berkshire Hathaway annual conference on May 3rd. And Warren, 94-year-old Warren, gets at this little table in like the middle of a stadium with a couple of other operators, Greg Abel, his newly announced new successor at the end of the year, and then Ajit Jain, who is the head of Berkshire's insurance operations. And there's a stadium full.
Well, Ajit wasn't there. I didn't see. It was just Greg.
Ajit was at the table. Yeah.
Okay. I didn't see. He never talked.
Oh, yeah. They asked questions. Ajit talks. And so Ajit is the head of Berkshire's insurance operations. There was an interesting conversation that they had about auto insurance. Mm-hmm. And what's interesting is like right now, auto insurance insures like human error, right? So like operator failure.
And soft fraud.
Yeah, maybe. But like in the future, as driving becomes more autonomous, like you're no longer insuring operator error, you're insuring liability risk of like the technology freaking out. So it changes the whole model. Like I'd never really thought about that. It fundamentally changes what you're insuring in the auto business. But anyway, that's besides the point. Warren Buffett for years has essentially, Berkshire has this annual conference. A bunch of shareholders show up. There's a lottery on who gets to ask questions. And Warren Buffett, this past weekend at 94 years old, sat there for 4+ hours and fielded questions from these shareholders. And I think, these things have, I would imagine if you looked at the attendance over the last 10 years, it's only grown and it seems to have grown significantly.
He draws a larger crowd than the Beatles did. It is unbelievable. For those who haven't seen it, just pull it up on YouTube. You could just look up 2025 Berkshire Hathaway Shareholder Conference and just look at the crowd. It's unbelievable.
It's a stadium full of people.
And they're all shareholders, by the way.
Yeah. So, and Warren Buffett sits there with a couple of cans of Coke and some C's candies.
Which he never drank. I didn't see him drink out of either.
And fields questions for hours. You know, it is pretty cool. And he just riffs in his answers. He's just like, you can tell that there's just so much there to kind of unpack in his mind. And there's always, I think anybody that's spent time listening to it, there's so many lessons on life and on investing. And I think as advisors, there's so much, as an advisor, you look at a client and you want to describe, your investment prudence. You might reference Warren Buffett. I mean, he's that powerful that as an advisor, attaching your brand to him is like having this podcast. And so he's become renowned as, maybe the most famous investor of our lifetime at the moment.
What's funny is early career, he mentioned, I think he worked for Salomon Brothers, if I'm not mistaken, as a broker. He and Charlie Munger, at least he referenced that during the shareholder conference. And he quickly became disenchanted with our industry. I don't know if you caught his comments about financial services and money management. Basically, I forget how he worded it. What did he say? He said they take a spread on your money, a 1%
an override.
fee. An override. Yeah, that's exactly what he kept saying. It's a wonderful business model, but he kept saying it's a wonderful business model from the money manager's perspective. He basically says wonderful, but not for the people. It's wonderful for the people that are running it. And I found that to be very interesting because obviously there's a market for what we do, or else we wouldn't have thriving businesses. So it's just interesting that Warren Buffett and Charlie Munger, he had a lot of distasteful things to say about money man. Charlie Munger would call him like the scourge of the earth or something.
If you think about what Warren Buffett did, he created like a wealth management, like an asset management business. Yes. And I think if I'm thinking about this from outside of the industry, there's not all asset managers created the same, right? Like financial planning. Like if you invest money with Warren Buffett isn't telling you how to handle your tax strategy, right? You're hiring Warren Buffett through buying Berkshire Hathaway to manage the individual holdings of the fund as opposed to thinking about your financial plan. Let's take a step
back real quick and describe or explain how Berkshire Hathaway is different than the average company, because it is not, while you can buy shares of Berkshire Hathaway, there's two classes of shares. You got a class A, which is something ridiculous. It's over $500,000.
780,000 roughly.
It's a ridiculous price per share. And then they got the class B, which is for us poor people. I forget what class B is, like 180 a share or something like that.
508.
Oh my gosh, it's gone up a lot. Yeah, so it's
maybe
obviously,
we should edit that part out.
No, I keep it. But I don't pay attention daily to stock prices, so I'm just pulling this.
You're only 500% off.
I literally pulled that back from my memory bank, and that probably was something that I stored maybe 4 or 5 years ago. At one point, it was that Berkshire Hathaway has just been a very successful company, and it's been a good stock to own.
If I heard a stat, so don't quote me exactly on this, but I heard a stat that over the last something like 10 years, Warren Buffett has outperformed the S&P by 2% per year. And if you think about like when you look, if you're in the asset management business, Warren Buffett is what's considered a value investor. Okay, he's not a growth investor. And if you look over the last 10 years, the managers that have done well are growth investors. For a value investor to have outperformed the S&P by 2% a year over the last 10 years, that's a big deal.
Yes. So take a step back. Let's explain Berkshire Hathaway. So Berkshire Hathaway is a holding company, meaning that Berkshire Hathaway doesn't do any one specific thing. So, you look at a company like Apple. We all kind of know what Apple does. They manufacture hardware and software, and they also run this ecosystem. The subscription-based ecosystem, which everybody loves, and it fetches a premium. It's a very well-run company, but that's all Apple does. Berkshire Hathaway does anything. They own railroads, they own utility companies, they own See's Candies.
Geico.
Yeah, Geico. They're a major shareholder in not Berkshire Hathaway, in Coca-Cola. So they just do everything. So it's a holding company. So it's a company, it almost resembles a mutual fund, an actively managed mutual fund, but it's not. Instead of charging a fee for buying and selling and doing all this investing, it's just a publicly held company that you can buy shares of.
Well, and that's where I was going earlier, which is that what Warren Buffett has managed to do is kind of create a mutual fund with no expense ratio.
Yes.
Right.
Yeah.
And I think that's it. That drives some of their cynicism on the money management business. And but I think for the listener out there that goes, well, gosh, Brent and Ben, then why do you, I charge a percentage of assets under management. That's how my business model works. Right. But I think what's happened in the wealth management space over the last, few decades is that it's gone from, hey, hire me and pay me 1% to pick all the best stocks for you, which I'll say is statistically hard to do. I think Warren Buffett's proven that it can be done. But really what you're paying us for in a lot of ways is the whole package, right? It's the tax planning. It's all the personalized, tax, insurance, investment, estate, all of the planning that goes into helping you architect out your investments, your spending, and what have you. And none of that happens. Like if I run a mutual fund, I charge a 1% expense ratio, I don't know anything about the shareholders in my fund other than they bought my fund.
Yeah, the days of creating value through what they call alpha, which is the ability to earn returns above and beyond the expense ratio or above and beyond the benchmark, those days are they're not gone. As you said, that Warren Buffett's proven that you can actively manage for alpha, but it's very unreliable. In fact, most managers aren't able to do it. So where we earn our value, like our clients would fire us if we didn't earn our fee. Where we earn our value is through usually the ancillary type of stuff. Yeah, we do offer investment planning, but mostly it's behavioral coaching. It's integrating tax planning, because how many times have you sat down with someone and you saved them $10,000 in taxes? I was meeting with someone the other day that was, literally about to do something that was going to generate a $38,000 tax bill that was completely unnecessary. So, and through a little bit of strategic planning, we were able to navigate around that. So, the value that we create is not necessarily in the investment alpha; it's in all the other stuff.
But I'll chime in though. Mm-hmm. If you think about the asset management business, mm-hmm. If I'm running a mutual fund, okay, it doesn't take a whole lot more, time to run a mutual fund that manages $100 million versus $1 billion versus $10 billion.
Oh, sure, yeah,
right. So it's from a scaling perspective. Like if you're sitting here going, gosh, does my advisor charge me too much or not? I think one of the questions you got to ask is, are you just getting asset management or are you getting overall planning? Because from experience sake, where you, the most efficient business we could run, we never talk to you. We trade the accounts, put them all in models, and it's, it takes very little time. You make a whole lot of money. Where you lose the margins, where you lose your profits, is spending the time doing the planning and doing the legwork to piece it all together from our side, right? Now from the client side, there's time and time again, it's been said that, like, if you look at clients, the value that they get from the advisor, I mean, sure, I think all of our clients are happy that we've grown their money. And if you're diversified and you've been invested, your money has grown. But there is a lot of value to just the conversations, not only the hard dollar things like the taxes, but the soft dollar things. So that's all to say that I think the way Warren Buffett looks at the asset management business when he expresses skepticism is really from the side of like a mutual fund manager charging a 1% fee.
Money managers.
And I think there's a big shift that's happening on the client side in our business that asking, like, what is my advisor really here to do? And I think people are becoming more and more aware of what a good advisor should be doing with you.
Yes. So back on to Warren Buffett. So I think that, we could spend all day espousing our virtues as advisors and our value, but I think we need to go back to some of these things that Warren Buffett said, because they're really quite valuable. And I don't think enough people watch these annual shareholder conferences. I know for years I discounted them. I didn't ever listen. I'm like, it sounds boring. I don't want to listen to these things. But Brent and I have some takeaways that we thought would be a good idea to broadcast to you all, so you don't have to sit down for 4 hours and watch the conference. But I would recommend it. By the way, he did open the conference with a movie recommendation. Did you watch it? It was a Netflix show. It was a documentary. I forget the name.
I forget what it was, but yeah, I wrote it down.
Yeah, I wanted to mention it. So as you look it up, I'll bring up one observation I took away from his comments, and that was that Warren Buffett obviously is extraordinarily successful. No one can disagree with that. You mentioned that he said the luckiest day in his life was the day he was born, which I thought, man, how great a statement is that? Just to recognize your good fortune in life and to have the optimistic outlook on things. But one thing that he said that he had the good fortune to enjoy in his life was really good in managers that he looked up to. So he mentioned he only had 5 managers that he worked for in his whole life. Can you believe that? That's what he said. So he had 5 managers and he admired every single one of them.
Okay.
Yeah. So I've had more than 5 managers. I'm only 41 and I've had more than 5 managers. I've admired quite a few of them, but not all of them. Certainly some of them I admired how poorly they performed.
Do we count like bosses changing in corporate America?
I would count that.
Okay.
Like anybody that you reported to, I would consider a manager.
Geez.
So, when you look at Buffett's success or someone like Warren Buffett in particular, he's a one of a kind. We're all ones of a kind and one way or another, but he is a special one of a kind. We admire him because it's like he is an example of a guy that's just been firing on all 8 cylinders his whole life. So he was born into good fortune for sure, but then he never let an opportunity slip between his fingers. So he was just very astute and paid attention to all the opportunities that he had, and he obsessively pursued every single one of them that made the most sense. So he's a good capital allocator, but not just in money, but in terms of his time. One other takeaway I had was there was a woman who got up from Poland, and she courted him. Did you see this? She basically said, Warren, you said in your book that, who was the manager of Geico or the CEO of Geico, that he basically accredited one of his Berkshire's original successes to the investment in Geico. And he got to that investment by shoehorning himself in some form of introduction to the CEO. I don't know the particulars of this. I'm just gleaning this from the
was
comments.
This the woman that asked for a meeting with him?
Yes. And Warren Buffett's response to her and her first request was,
"There's 40,000 people here."
Yeah, no. He said in his original response to her original letter, he said, "I only have 3,000 days left. I have higher priorities." and then by the way, I think what she did was a little grimy. You don't corner someone in an audience.
Yeah, it was a little
40,000. Like, come on. I appreciated Buffett letting her down. I thought for a moment that, he's going to actually give it to her, but he actually said, "No, sorry. He
said if I gave 40,000 people 1 hour each, I wouldn't have any time left."
That's exactly right. So what I mean by that, to come full circle here, is a phenomenal allocator of his time and attention. And this day, how important is that? How much time do you give away, Brent? I know I do, to just meaningless, frivolous things, doom scrolling.
And this transcends through his personality, not just with his time, because if you look at what he said about people in your life, he said, quote, "Make the most of people you meet who are going to make you a better person, and forget about the rest, frankly."
Yeah, and he did not entertain tomfoolery. That's why he had only 5 managers, and he admired every one of those managers. He might have had more managers, but he immediately terminated his association with them. So there's 5 managers that he committed his life with, and I thought that was really interesting.
I think there's a lot of importance. So like I'll bring this to myself. I mean, one of the things that I thought was, so in my life when I was in college, as a freshman in college, I was as a biology major, and I was hanging out with they weren't like it wasn't like a bad crowd. It just wasn't, the people I was hanging out with weren't as motivated as maybe I saw like I wanted to be. And I thought about it. I remember the moment where I thought about maybe that was backwards. And so I actually ended up going to the fraternity that I joined. And when I showed up there, a lot of the people that were in the fraternity were involved in school, and they were involved on campus. They had good grades, and they had motivation and drive. And I signed up for that. And a big part of that was just like, I think putting yourself around people, there's so much to be said for like who you surround yourself with and how that pulls you. And I think if you put yourself around people that you perceive as really effective people, it naturally pushes you to do the same.
Oh, absolutely. Competitive pressure. So for this actually is a biblical wisdom. The saying goes, don't throw pearls to the swine. My dad had a saying, and my dad, he passed away in 2021. I miss him dearly, but this statement always stuck with me. And he would tell me when I was a kid, he said, "Ben, it's hard to soar like an eagle when you're surrounded by turkeys."
Yeah.
That's a blue collar way to say what Warren Buffett's trying to say. And that's surround yourself with people that you admire. It's also true in athletics. You'll notice that there's certain schools that churn out more professional athletes than others. It's because when you put someone in an environment where they have to themselves raise their own bar in order to compete, they're going to do that. If you put someone in an environment where it's easy to win, they're just going to rest on their laurels. Most people will.
We respond well to being challenged.
Yeah,
like human beings respond to,
yeah.
I mean, think about all the hard things. And this was another thing Warren Buffett talked about. He was asked a lot about setbacks in life. I think he said that when eventually you die and that's the ultimate setback. But, he talked about setbacks being inevitable, and he talked about the ability to persevere and see the positives in your life through those setbacks, which is interesting because I know is in a podcast on religion, but Warren Buffett isn't a religious person. And I think a lot of people use religion to kind of back up and see those positives through the negatives. So the fact that he, as somebody who's agnostic, has been able to find, zoom out and see all these positives in life through the negatives. And he referenced, they asked him what the key was to a long life. He said neither Charlie or him or any of their other friends that lived a long time really exercised much, and they all ate junk. And so he kind of attributed the long life to the optimism that they shared. And Warren Buffett is, he's patient and skeptical and all of those things, but he is very optimistic. If you ask it, I think he's been quoted in the past of it being asked, what is his favorite holding period for a stock? And his answer was forever.
Yes. Well, yeah. He's a buy and hold investor. That leads us to some other comments that he made, which I think are more germane to the investing topic. And that is that he really doesn't worry about stock market drops. In fact, I don't know if you recall this, because I think you were in school or something in 2008, 2009. Do you remember that? His Buy American call? I remember this. Warren Buffett came out with the Dow was down something crazy, something ludicrous, like 50%. And he came out and said, "Buy American." I'm buying, and he bought. Now he got a sweetheart deal. Berkshire Hathaway did for in its not acquisition, but its investment in U.S. Bancorp.
He made a whole bunch of sweetheart deals at the time. He was buying shares in Bank of America and Goldman, and he was getting options, like warrants, in addition to his equity ownership. The benefit of being Warren Buffett is that when you can provide somebody $5 to $10 billion all at once, you get a little better deal than somebody that can't provide that liquidity.
Well, he prided himself during the shareholder meeting as a company, not himself, but Berkshire Hathaway as a company that both the public and governments could rely on to make good deals. That it's a company that can be relied on when times get tough. They're going to provide liquidity. And I really admired that in him. And I believe Greg is going to, by the way, can I take a moment to just say how hilarious that the guy that's taken over this company, this pinnacle of American success, his name's Greg. not anything against a guy named Greg. It's just, Warren Buffett just sounds so sophisticated, but anyway, but Greg seems like a good guy. He does definitely lacks some of the charisma that Warren has, but I think maybe we just have to go through an adjustment period and we'll get used to that. But so it's easy to criticize someone like Warren Buffett. It's like, oh, wow, it's easy to be optimistic when you've got billions of dollars. It's easy to be optimistic when you have a silver spoon. But that's not necessarily true for Warren Buffett. He kind of just had this very not aggressive. That's too that's the wrong word. He had a very strong work ethic. I read that in high school that he was very entrepreneurial, and he filed his first tax return at age 14. Actually used his bicycle as a tax deduction, probably running a paper route or something. And that by the time he graduated, he had almost $10,000 saved up. His own money. This wasn't his father's money or his mom's money. This was his own money through his own hustles that he did. And in today's dollars, when he graduated high school, in today's dollars, this is equivalent to $120,000. Can you imagine having $120,000 today, having graduated high school? So, Buffett he's always been a hard worker. He's definitely attributed a lot of his success to the people he surrounded himself with. But I think that he proves that you make your opportunities in life, and the more often you go up to the plate, you take the effort to walk up to the plate and you swing at pitches, the more often you're going to find success and luck. So that's a lesson that I took away from Warren, is that it's easy to critique him and say, oh, his life is all cushy and rosy because he's got $1 billion, actually, I think his net worth is like 156 billion, which is absolutely incredible. But I don't think that it was all easy come, easy go,
Well, one of the interesting statistics that I kind of like, and you've made this point, and I think, again, as wealth managers, we and financial planners, we really want to emphasize certain just truly important concepts. And compound interest is so hard for our brains to really truly understand. I mean, we've seen graphs of how exponents work and whatnot, but the value of time in investing, and as it relates to compounding, it just can't be understated how valuable that is. Warren Buffett's returns have been good. I think I just looked it up, and his returns from 1965 through 2024 were something like compounded 20% per year. His returns have been good, not taking that away from him. But if you think about how long he's been investing, to your point, he started at like 10 years old. Right. And he's 94 years old now. So I just for sake of it, I did the math. Okay. So just easy numbers. I've got my financial calculator in front of me here. You have $100,000 and you earn 10% on that money, which, by the way, over the same period of time that he earned 19.9, the S&P was 10.4. Okay. So let's just say you earn 10% per year, and you do that. A normal person's lifetime, let's say they start investing at 22 and they live into their 80s or 90s, let's say 60 years, right? $100,000 grows to $30 million over 60 years at a 10% rate of return. What happens if I make that 90 years instead of 60 years?
And add to it every year.
Well, and let's forget about adding to it for sake of the example, just to not overcomplicate things, but 100,000 growing at 10% for 30 years, still a big number, right? 30 million or whatever it was. If I extend that 60 years to 90 years, you go from having 30 million a growth, 100,000 turns into 30 million to 100,000 turns into $531 million, right? That's a 15-fold increase in 50% of the time.
Yeah.
Okay. So part of Warren Buffett's insane wealth, like if you go look at it, when I was born, 1990, he was worth about $3.5 billion. What did you just say? He's worth about
156 billion.
So more than like 97% of Warren Buffett's wealth has been created during my lifetime. So since he was a 60-year-old.
Yes.
Right. And when he was 60, he was still regarded as one of the most successful investors, if not, over time. So it's pretty incredible when you actually think about the power of time and compounding. If you can just, and not to say that everybody's goal should be to grow their money to the sky, because I think as investment, financial planners, our goal is to try to get you to spend some of that money and not die with 531 million. But understanding the value of giving yourself an extra 10, 20, 30 years of compounding, especially for families that we work with where they are looking to really grow true family wealth over time. If you can pass that money down an extra generation and give it a few extra decades to grow, the difference is really big.
But the purpose of the money really matters. And I think that that's another lesson to glean. It wasn't outright stated during the conference, but it's pretty well known that Buffett intends on giving away most of his wealth. Like he's not going to just uh, hand it over to the next generation without, without any strings. So I believe that his legacy is going to be more similar to that of like Benjamin Franklin, which is one of his idols. Did you hear him talking about Benjamin Franklin? One of the questions he got was, if it was 1776, by the way, I keep going on these tangents, but I found this to be hilarious. You said that the questions were lottery driven. Why is it that half the questions were all minors? They were all like kids, 17 and younger, and they would ask like, I shouldn't say that they were silly questions, but they were like pretty obviously like juvenile questions. Like every kid was trying to like launch their success in their life on the same trajectory that Warren Buffett was. Like they're looking for a launching pad. But the questions were always somewhat ridiculous. One gal basically wasted her question on trying to ask Greg, like, what are you going to do about global warming to save my life? Basically distilled to that. And then the next the kid was like, what high school class did you take that made you the greatest investor of all time? Warren Buffett basically responded, said, I basically just read every book in the library that was about investing. So, what are you doing?
Yeah.
But anyway, I digress.
Well, I have a hard time with it in some ways because I really enjoy, I teach a class.
Yeah.
And I really enjoy the mentorship elements of it and being able to share, and help guide some of these young people to be more successful. And so I have a soft spot in my heart for what, for some of these younger folks coming up and asking questions. I was a little disappointed. Like, I'll give you the other side of what you said. There was one young woman who asked a question like, what would you say is, the number one key to success or something to that effect? And they basically just said, work hard, and moved on to the next question.
That was a good, and I do have a few comments about that. That was a very good question. I did like that question, but the response I felt was lacking.
That's what I thought.
Yeah. So here's how it goes. Now, I would say the better source material to reference for a lesson on like, okay, what should I do to find success isn't to ask a question in the Berkshire Hathaway annual conference and expect all your answers in like a 5-minute response. That's just an insane thing. These really lofty questions that they lob over to Buffett and Greg and all these, I don't really appreciate those. I like the more technical questions. I think that's a good opportunity. Questions that can be answered with precision in a 5-minute response. These like, tell me how you became so successful kind of questions. I think that they were over asked during the conference. But back to that response. So the gal asked like, what can I do? Her question was like, what can I do to become a team member of Berkshire Hathaway? How can I become an employee of Berkshire Hathaway? And Greg's response, Buffett deferred to Greg because he basically said, well, I'm not the future of the company anymore. Ask this guy over here, and Greg's response after he meandered for a while was basically work hard. It's like, okay, yeah, thanks for that, Greg. You can work hard moving dirt, a pile of dirt from one foot to the next foot. What people need, what people crave, and they're missing today because our education institutions have failed them is direction. You not only do you need to work hard, you need to work smart. And I think that latter part is what's lacking. And I was a little of a bit of a missed opportunity that Greg didn't kind of provide a little bit of that direction. It's like, okay, you said work hard. Where? What do I work hard at? So I see a lot of youth in our culture today. They have the work ethic. That is something that I really detest when I hear the older generations. Oh, the young people have no work ethic. It's like, no, they've got lots of work ethic. I see that. They just don't know where to apply themselves. They don't know what to learn. They don't know where to deploy their talents. They're being told that, the world is burning up and that the climate's in disaster and that that AI is going to take over and, everybody's living paycheck to paycheck and you're doomed. That's kind of the predominant message in the zeitgeist right now. It's just a shame. And I was hoping for an answer from Greg that was a little bit more specific. Like, it would have been nice for him to say, you need to read these books or major in this particular field of study. We see a lot of opportunity. For example, they did allude to this in utilities. So they mentioned that there was, and they're being very cryptic about it, they kept referencing a opportunity in America akin to the highway building project that Eisenhower performed. It had to do with like energy distribution and generation projects. And it was never, AI was never mentioned, but it was alluded that it was the demand was driven by this emerging technology. So it would have been nice for him to say like, oh yeah, that's an industry that you should definitely learn more about, become an expert in this. So that's just my thought and my response to that question.
I thought his response was, it's fine. I get it. But I just thought it was basic. I think we're all looking for, I think we all want to say we trust Warren Buffett to make the right decision on who the operator is, but I think we've said it a couple of times. Greg may be a really excellent operator. I think we're all longing for the charisma that Warren Buffett brings to the table. There's just something to listening to the way that he thinks about things and his answers that helps you think a little bit differently.
Well, and Charlie too. If Charlie was almost more of a character, and that, for those of you who don't know, that's Charlie Munger. Charlie Munger was more of a character than Warren Buffett. If you haven't bought Poor Charlie's Almanac, I would recommend it. It is a phenomenal book, just packed full of Charlie's little nuggets of wisdom and investing wisdom. But he had a lot of hot takes. For those of you looking for a peek in that, I did a newsletter on this. So you just go to carrotstick.com, carrot, Karat. I wrote a letter. I think it was like Lessons from Charlie or something like that. But he had some hot takes, a lot of charisma, and Buffett did too. And I'm curious to know how is that going to, how's that going to play out with Greg at the helm?
And I think we may just see a more systematic Berkshire Hathaway, and there's almost a little bit of magic that will be lost.
So no squishmallows.
No, yeah, exactly. But I think from a shareholder's perspective, do you want to watch the guy eventually pass away in the CEO role, or does it make more sense that he passes that role off and provides clarity and direction and control while he has that? I think in financial planning, we really preach, taking advantage and setting a transition plan in place proactively. And so, I think it's a good thing that we've got an established, transition plan within Berkshire. I just wish that there was somebody that could really truly replace Warren and Charlie. And I don't know.
Yeah, so. I really appreciate it. It says a lot about the culture of the company. I really appreciate that it's not some like big power struggle, there's no, usually when you have a CEO resign, it's most often these days it's in disgrace, it due to some scandal, but that's probably not true. That's just usually it catches the headlines because of a scandal. So, there's a little bit of data bias there, but I think that it's really refreshing to see that the company is just the transition so silky smooth. And it's also refreshing that Buffett is not, while he is 94, so there is a clinginess associated with it. I think that sometimes people hang on too long, way past when they should. And it's really refreshing that Buffett, even at 94, better late than never, as they say, has recognized that it now is the time. I actually found it. What would you think about this? That he sprung it on everyone. He said the only two people that knew that what he was about to say, it was in the last 10 minutes. It was in the last 10 minutes of the conference. He says only two people know what I'm about to say. It was his two kids on the board that served on the board of Berkshire Hathaway. And then he just basically dropped the bomb. He said, "Well,
even Greg didn't."
Yeah, even Greg didn't know. and then they had the standing ovation, which kind of came, or it was organic, like came out of nowhere. The standing ovation was triggered when he said, I have absolutely no intention of selling any of my shares. And everybody stood up and they clapped, and they kept clapping for like 4 minutes. And he kept trying to go like, okay, all right. And he finally said, drink your Coca-Cola and calm down, which I thought was funny, but he finally got everybody calmed down. But, it was funny just seeing Greg stand up there clapping. And I thought to myself, I wonder what he's thinking right now. I wonder if he's thinking like, okay, that's enough. I wish I could sit down now. Have you ever clapped for 4 minutes before?
No.
It's entirely too long. It is way too long to be clapping.
Well, yeah, and that was the headline of the event. I mean, if you didn't know who Greg Abel was before, and we've known about Greg Abel for a while now, but I think the world is the official announcement of Warren Buffett's retirement is going to push Greg a little bit more into the limelight. So we'll see how that how that works out. I think one of the other things we'd be amiss to miss as we get towards the end of this podcast is the massive cash pile. We've talked about this.
Yeah.
You and I have talked about this in past podcasts, because I think our last episode was, if you've been fully invested going into the market downturn, do you feel like a sucker? And I think market timing is one of those tricky things. You don't want to it's not good behavior to try to time markets. There's all sorts of data that supports why you don't want to try to market time. But then you think about Buffett, and we talked about this last time. He's got a bit of a unique situation. Like you said, he's almost looked at as like a capital provider when things get a little stressful. And Warren Buffett, I just loved his answer about a lot of this, because he spent the time, people asked about the cash, and he spent his time talking about patience. And this is one of the things, like when I'm teaching my class to young people, I talk a lot about how in the first 10 years or so of your career, you want to focus on building your expertise and building your skill set, and then building your flexibility. And if you do those two things and you remain patient, when the right opportunity comes up, due to the expertise that you've developed, you should be able to recognize it. And due to the flexibility that you have, you can capitalize on it. And I think Warren Buffett, to me, really packaged that nicely when he talked about their cash on hand. I mean, he said, don't mistake patience for unpreparedness. He's like, we're very patient, and we want to be in a spot where if the need came to put $10 billion into an investment or $100 billion into an investment, we want to be able to recognize that very quickly. But that doesn't mean that we're constantly doing it. So they spend their time researching, being aware, and waiting for the moment.
Yeah, they're very particular. So they have an investment. Every board that applies really prudent capital allocation strategy has a minimum standard for risk and return on investment. And Berkshire Hathaway's processes, which is very proven, is especially disciplined.
But I think that's besides the point. I think the point is, like, as you how you apply that in your life is to recognize that your life, a lot of the outcomes in your life are going to be driven by a couple of moments. Like, I think we were just talking about this ahead of time, as far as like how your life is different than my life because of events that happened early on in our career, some of which were things we could control, like, how you invest your money and things like that. Others that you can't control, like just simply timing.
Yeah.
Right. You can't control timing of everything. And I think what's really critical is to think about how to, again, be patient. I think a lot of people let impatience get in the way of real strategy. Right. And I think the most successful people that I see that we work with, there were really key moments in their timelines, in their lives, where they did something that ended up changing the game for them. And I those moments aren't counted on like hands and feet. They're counted on like one hand when you go back in your life. And so I just think it's so important to remember to be patient and be prepared. And really, when you do get presented those opportunities, recognize them and then step up to the plate.
And also understand that you create your own opportunities. So, Buffett said this multiple times that, there are very rare instances where the investment opportunity was just fantastic. He actually mentioned one of those opportunities was 2 years after he was born, and he was too busy worrying about the kid in the crib next to him to take advantage of it. It was a huge one of his life's blunders.
Yeah, because I think he said that the Dow Jones when he was born was at like 240.
Yeah,
and it went to 40.
But let's focus too. I think we got to be careful about sending the message to everyone that what you need to do is do what Buffett does and hoard cash and wait for like these fantastic buying opportunities. Fact is, like myself included, I'm just not I'm not an oracle of investing. I'm not a stock analyst. I can't run Berkshire Hathaway. Most people can't, because most people aren't Warren Buffett. There's probably someone out there that's going to rise up to be the next Warren Buffett we were talking about before the podcast, but we don't know who it is. But what we do know is that everybody who's listening to this, you have a specialty in something. Most people, their specialty is what their career is in. And I think about my own success. We were, before every podcast, Brent and I go out to breakfast and we kind of just hash out things that we don't necessarily talk about what we're going to talk about here, but we talk about life. And one subject that came up today was just the difference between your career launchpad and my career launchpad, and how that timing difference really it sent us on two different trajectories, and pros and cons of each. So it's not like mine was better than yours, but I can point back to my life and look at certain points and say, that is where it turned around for either the better or for the worse. And almost every one of those points was some major decision, that was a consequence of an opportunity that I generated myself. One of those was the decision to go become an independent financial advisor, which took place in 2013. Up to that, I'm not going to go through my whole life story, but up to that point, I really trudged through this career. It was very difficult. In fact, I tried to get out of it a couple times. I tried to become a network engineer. I tried to become, an Air Force officer. I was desperate for a solution, which kind of goes into what you were saying is people are impatient, including myself, yours truly. I was impatient for a solution. I needed cash flow because it's difficult to break in this business, especially if you happen to launch your business in 2006 before one of the worst recessions we had since the Great Depression. But I digress. In 2013, I made a couple of really difficult decisions. These were not easy decisions. They involved me changing careers. I actually had to move. I took myself out of the security of working for a corporate American job and became fully self-employed. It was incredibly uncomfortable. But I can also say that was the moment that my life changed.
Like I said, you have to have expertise, and you have to be willing to be flexible. The expertise allows you to identify the opportunity. Is this a good opportunity? Is this a bad opportunity? Your expertise is what you rely on to tell you that.
Yeah. And
then you have to be willing to be flexible, right? You can recognize a good opportunity all you want, and it's not in your town that you live in, and you're unwilling to move, and the good opportunity is going to pass you by, right? So flexibility can look like a lot of different things. It can be like I have 2 kids and 1 on the way. I would say that my kids reduce my ability to be flexible in my career, right? I love my kids to death, nothing opposed to my kids. But like, ideally, if you are single and willing to move with a big pile of money, you have more flexibility than anybody else, right? But there's a lot of things in life that can reduce your ability to be flexible. And it's not to say that that's bad.
I'm going to push back a little bit on that. I don't think my kids don't hold me back. But what it does do is it increases my sensitivity to risk.
You're not going to take your income to zero if it's going to mean that you're not going to feed your kids. I mean, that's the reality. Like, I would eat ramen noodles if I had to every day to like make my business succeed. And that's great. That's a conscious decision I can make. I'm not going to force that conscious decision on my kids, right? So I don't really like it being framed as like my kids are holding me back, because that's not how I see it at all. But my point is that the more willing you are to be flexible, the more likely it is that when you recognize the opportunity, you can capitalize on it.
Yeah, and that's the whole story behind Berkshire Hathaway hoarding cash. Hoarding's probably it's a pejorative. I shouldn't use that. They have a record amount of cash on their balance sheet. And the reason is because they want to maintain maximum flexibility going into this industrial change that we're about to experience. I see it coming. Everybody sees it coming. It's just not crystal clear what's over the horizon, but we all as Americans see something shifting. And I think that a lot of this has to do with, not necessarily the tariffs, but he did comment a little bit on tariffs. I wanted to get your take on that. And then
he just basically said, look, I mean, free trade, exchanging the skills that you have, that the things that you're good at for the things that somebody else is good at is better than trying to be good at everything and end up being mediocre at all of it, right? Like if you get, just like we were just saying, get really good at what you're really good at.
Yeah.
And focus on that and outsource the rest.
Yeah. So he did say that. But anyway, what I'm trying to say with like the tariffs and like this big change coming over the horizon, which I think is anchored in like this AI innovation, and automation. Because we're talking, you mentioned the insurance, Geico insurance or whatever insurance, where now it's shifting entirely from
insuring liability, company liability.
Well, it's because now cars are starting to drive themselves,
right?
And imagine like this is going to be incredibly disruptive, and there's a lot of unknowns when it comes to okay, where should I allocate my capital to best take advantage of this opportunity? I don't think Berkshire Hathaway. Now, again, this is not a solicitation of the stock or meant to be an analysis of the stock, just as as a disclosure here. Brent and I are both shareholders in Berkshire Hathaway, but we're not recommending that you go out and buy the stock. This is just meant for, commentary because we feel, Warren Buffett is, there's a lot of wisdom packed in that man's head.
We will likely be talking about him for the rest of our careers.
Oh, absolutely. So what I was saying is that, I think Berkshire Hathaway sees what everybody else sees, and that, the landscape is shifting and we don't know who the winners and the losers are going to be. And in this environment, it's best to maintain flexibility. And what is more flexible than cash? Now that flies in the face of kind of what we said in the last episode, which is what do you do with a lump sum pile of cash? And not, most of the time it makes sense if you don't have plans for it. That's the key thing, the key differentiator. If you don't have plans for it, Berkshire Hathaway doesn't have plans for its cash. It's just surveying. Say, okay, what are we going to put the money in? They know it's going to be for an investment. They just don't know what yet.
And let's be clear, the cash, I mean, every time the market goes down, people like to make jokes about Warren Buffett sitting on all this cash, just wringing his hands. But the cash has only hurt their portfolio over the last few years as the market's going up, right? So,
and he'd be the first to tell you that it wasn't an anticipation of a short-term market drop.
Right. He's not sitting around. Well, he did say that he's confident that at some point in the next 20 years, we're going to run into something, doesn't know what, but it's going to push the market down 50%. He talked about how there's been, I think, 5 times in his lifetime when Berkshire stock had gone down 50%. He made a point to mention that doesn't scare him at all. He sees it as an opportunity. And every one of those 5 times has ended up being a real positive over the long term. Right. And I think he made a mention that, he's an emotion. He said, it's not to say I'm not an emotional person. I'm just not emotional about the price of stocks.
Yeah.
And it's just, we talk so much about that as, one of the keys of successful investors is not to get freaked out about market volatility.
You know what he is freaked out about? Currency. He did say he did have a lot of concerning things to say about our fiscal deficit. And he mentioned that we're on an unsustainable path, running basically 7% deficits. He said that sustainable deficits are around 3%. So he did reference that he's concerned about currency. And I don't know if he's really concerned about it as it applies to his life, because he is, as we said, 94 years old. But it is something that we as Americans need to be cognizant of, is the debasement of currency, because if that concerns Warren Buffett, it concerns me too. And we'll have to have a whole nother podcast about that.
But I still don't think. I mean, I if we get a big dislocation in the market, Warren Buffett is not going to say, "Oh gosh, the whole game is up. Let's fold up all shop."
Oh no, he doesn't.
Market volatility will happen. Maybe the instigation, maybe the catalyst for that is going to be deficit spending and the debt. While that feels louder than ever before, I've been hearing about that for the last 10 and 15 years, and who knows when that'll come to fruition, being a real big problem.
Well, as I said, that's a topic we should unpack in another episode. For now, we've filled out almost an hour talking about Warren Buffett, which I think is a worthwhile subject.
Let's what are some, if you're listening to this podcast, Ben, what would your key takeaways be?
My key takeaway from just Buffett's life is just be careful who you surround yourself with. Be very thoughtful about the people you affiliate with. And I can attest to this in my own life. The moment I surrounded myself with people that were more talented than me was the moment that I really found accelerated my success rate. And it also forced me to be a better person. One of my first moves in that direction was marrying my wife. That was in so many ways, she's a better person than me. And in so many ways, she has made me a better human being. And I've taken that lesson, I've applied it professionally in my life. And Buffett's done I think he's like the Michael Jordan of this, like in terms of surrounding himself with just admirable people. So I would definitely assess who you have in your circle and who you should be closest with. The next thing I took away, which is more of an investment theme, and that is, do not be afraid when the markets are afraid. So he says the best opportunity is when people are at their silliest. So don't run with the herd just because the herd is stampeding. You want to stand out on your own and assess where is the herd heading and why are they heading there. So try to compartmentalize your feelings and emotions when it comes to investing, because they're often emotions, and feelings are often your enemy, not your friend when it comes to that.
Yeah, and I think from my side, and I really, for the clients that I work with, I really talk, or that we work with, we talk a lot about the need to have flexibility in your financial plan. And it doesn't always look like a big pile of cash like Warren Buffett, but I regularly see young people that have more money in retirement accounts. I mean, I'm not saying it's bad to have money in retirement accounts, but if all of your money is in your retirement account and you are house poor outside of your retirement account, that doesn't leave you in a position to be able to manage your life when things inevitably change. And Warren Buffett talks a lot about change being inevitable, the ability to be patient and to be flexible as an asset. And to me, there's just so many people that prioritize the saving element of what we do. You hear people like Dave Ramsey saying, pay off your house and contribute to retirement. And again, those are fine things to do. But if you lose your ability to be flexible along the way, like the client, I don't care if a client has $1 million in their retirement account. If they're 40 years old and they have $1,000 in their savings account and a house, they don't feel like a millionaire.
No.
And if you are proactive, rather than trying to say, oh, I know the future, if you instead admit that you don't know the future, and so you need to plan to be able to handle the future as it throws you turbulence, I think there's really a lot of value in that. And I think, in what we do, it's just such a rewarding career. I guys like Warren Buffett probably get a lot of validation getting into a stadium with 40,000 people or what have you. But I think for us, like, there's so much validation that we get watching people make material shifts in their financial situation and make progress and accomplish the things that they want to accomplish, and, you know, start to see opportunities and paths that they didn't see before they had a plan. So that's what I have to say.
Oh, that's great. Well, I appreciate everybody tuning in and listening. Well, I guess you don't tune in anymore. Thanks for breaking out your smartphone and opening the podcast application and hitting the play button. Of course, tuning in is a lot easier to say, but I appreciate your time and look forward to catching you next time. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.